Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Keith Weiner. He is a leading authority in the areas of gold, money, and credit. After observing investors forced to choose between a return-free risk or a high risk to get sufficient yield, he founded Monetary Metals in 2012. The company's vision is simple. A working gold standard is when anyone can deposit gold and earn interest. Keith is the founder of Diamondware, a software company sold to Nortel in 2008, and he currently serves as the president of the Gold Standard Institute, USA. He earned a PhD from a non-accredited New Austrian School of Economics. And Keith, welcome to the show.
Thanks for having me, Keith.
Yeah, appreciate it. I always like to kind of start, if it's okay with you, kind of where you grew up and what eventually got you into, in this case, precious metals. I definitely want to hear that backstory, though, with the software company as well.
So I'm a New Yorker. I grew up in what city people would call upstate. That was just a commuter suburb. Went to school at RPI, Rensselaer in upstate New York. That is real upstate versus where I grew up, which was, as I said, commuter to the city. And if you're a New Yorker, you get those distinctions. Anybody outside of that area will be like, what is he talking about? Majored in computer science. I was your typical computer nerd. Dropped out like so many of my heroes did before me. Wanted to build a software company. Created a company called Diamondware. We went through a couple different business models before developing a 3D audio technology for voice communications. So just starting to see that today. I've noticed like Apple FaceTime has it, Microsoft Teams has it now. But we built it, patented it, made it work back in 2002 to 2005 timeframe. And so when you're in a conference call, conventionally all the voices are jumbled up, so people talk over each other. There's no intelligibility. It's fatiguing to listen that way because you're trying to figure out who's talking. And people have similar voices. And so we created a stereo synthetic sound field, and each voice sounded like it was coming from a different place. And so intelligibility, when people talk over each other, is much easier to tell who's talking. It works. So anyways, that company was sold to Nortel August 19, 2008. It was real. What was going on, right after that, certainly. And so that was, kind of my formative, years in business.
Yeah, that's pretty amazing. So, yeah, and we were talking a little bit before the show, but you were saying that was officially their last acquisition, right? Before filing bankruptcy. Yeah.
Nortel was at one time the biggest market cap on the TSX stock exchange. I think they had an $800 billion Canadian valuation at one time. At the time they acquired us, they were 35,000, 40,000 employees. It's a massive company. who knew that was going to be the end of it? But obviously, fall of 2008, a lot of companies failed that nobody thought, were going to fail. And they were certainly not the only one. So, at first I felt very bemused. It was a surreal experience to sell a company. It was a life-changing amount of money, for me personally. But then it became more and more alarming as the events of fall of 2008, began to unfold. And I started to, okay, can I lose everything? And what am I doing with my money? What do I invest it in? Where do I put it? And so that's when I started to obsessively, I felt like a moth drawn to flame, just obsessively reading about, monetary system, financial system, what's going on. I read what, you have to call doom porn. I was just eating that stuff up. Eventually coming to the new Austrian school and this old Hungarian professor, and not really intending to become a student, but just being very interested, taking some of his courses, started to write essays. And then, he encouraged me and said, yeah, you have enough here to make a dissertation. I encourage you to apply. And ultimately coming out of that in 2012 with, again, not accredited. I could never get a job with this as a credential. I don't want to, mislead anybody. But the work was real. And, I was studying what's wrong with the system and what would right it. And what's wrong is that dollar is irredeemable. And so what that means is the dollar is a debt instrument. So we pay debts using a debt instrument. How does that work? You never really actually pay off a debt or extinguish it. You just shift it around all over the place. And so the debt grows exponentially. That's actually a feature, not a bug. That's how the system is wired. And so, if you scared at 34 trillion, I was going through some of my old essays because I started to write a lot, after this. I think it was 2014 or something like that. And I was talking about, I was at 15 trillion in debt and, how horrific and scary that was. Well, that seems pretty quaint today. Oh, 15 trillion. We're 34 now, right? And, in 8 years approximately, we'll be at 68 trillion. And these numbers are unreal. People's eyes glaze. But the system breeds debt. This old Hungarian professor's name was Fekete, used the analogy. Imagine if every time you had to throw out the garbage, you shoved it up in the attic. That's kind of what system does. And eventually, it's going to come down on your head. That's not how gold works. So I thought, okay, we need to bring gold back as a serious financial asset. And so, if you talk to other guests on your show, I don't know, talked about gold, it's always about betting on the price action. I mean, it starts out with, okay, there's a problem with the dollar has inflation, all of that's true, buy gold. Okay, that makes sense. And then somehow it turns into, come on, baby needs a new pair of shoes, and rolling the dice at the craps table. And everybody wants gold to go up to whatever magic number they may have in their mind, $5,000, $20,000, $100,000. And then what? Then you're going to sell the gold to get the dollars that a minute ago you just said were going to be worthless, right? So it just becomes a gamble and just a different chip in the Fed's casino. And a lot of the gold bugs resent when people make money in real estate or stocks, and they think that there's a certain financial justice to make money in gold rather than. But anyways, it's not taken very seriously by the mainstream, and it's not hard to see why if you look at it objectively. But if gold had a yield, if someone bought a gold bond that paid a coupon in gold and the principal and the interest were denominated in gold and payable in gold, it changes everything. And that was kind of the vision of how do you make gold a mainstream, a financial asset that, it's not just about the gold bugs, which are a pretty small market. It's, everybody in the world needs to get interest on their savings ultimately. And that's what to do. But interest is something that's not subject to, inflation and deflation and devaluation and all the manipulation allegedly to make the economy better. That's why they say they're doing this to us for our own good. You see, because if the consumer prices are rising fast enough, it's going to generate jobs and exports. And so that's just enough of a mask or a facade that people just sort of go along with it. Okay, I guess. But it's not really serving the savers very well. Or the investors, frankly, right? So, you buy real estate, it goes up, you sell it. how much of that was really the investment going up and how much of that was the dollar with which the investment is measured going down? And there is no real way to answer that question. I mean, I can propose measure everything in gold, which is certainly much better than measuring in dollars. But, you need something that's real, and that's what gold brings to the table.
And so, why do you think? I mean, we've gone away from the gold standard here in the U.S. It does seem like countries are starting to kind of collect more gold, but what are some of the things that you're saying to bring gold back into kind of the mainstream? Tell me a little bit more about your philosophy there as far as being able to do that.
So, you want to talk about why bringing it back matters, or specifically about the mechanics or strategy of how to do it?
Let's maybe start with why, and then we can talk mechanics right after that.
So, I wrote an article for Forbes talking about inflation. And, I think if I recall that, this was 10 years ago or so now, but I think that article I talked about Joseph Stalin, who said, one murder is personal, but a million is a statistic. And, it's antiseptic and, desensitizing. Oh, a million dead. What does that even really mean? Right. So
Right.
they try to paint inflation as a statistic that, okay, last year consumer prices were X and this year consumer prices are X plus whatever, 3%, 5%, doesn't matter. So it's very antiseptic. It's very clinical. It's very abstract. It's very theoretical. And it's a bunch of, PhDs, sitting around debating what's the right amount and how do you measure it. And you can't really make any headway there. You say, well, this is wrong. Okay, well, everyone has a different theory as to what the inflation rate should be. But the point of the article was, I started out with that Stalin quote. The point of the article was, it's not really a statistic. At its heart, there's a dishonesty to it. And that is when you have a borrower, it's called a borrower, should put that in air quotes, borrower, doesn't have the means or the intent to ever repay. So imagine, you have a kind of deadbeat 15-year-old kid. He's like, Dad, can I borrow $1,000? Now, a lot of people would say, what do you need it for? But I think the second question is, how are you going to repay that? I mean, you don't have a job. You sit on Xbox all day. What? And the kid just says, well, someday, somehow. And, normally, I mean, maybe you want to give your kid a gift of $1,000 and maybe you do it. But, normally you just, okay, well, you don't have any realistic hope or plan or means or intent to repay. So I'm not going to call that a loan. I'm not doing that. But imagine if, so for some reason you did do that. And then there's 1,000 other people in your neighborhood that all lent their deadbeat kids $1,000 and you bundle them all up together. Now you have $1 million asset-backed security. And then you go to, you create strips or tranches of it. And then you get the top, 60 or 70% of it AAA rated and you sell that as a bond, to the market. But what's backing it is a bunch of 15-year-old deadbeats. There's no intent to repay it. And that's inflation in my book. It's a counterfeiting. There's a fraud going on that should never be admitted into the monetary system or financial system. And that's the US government is doing this.
Right.
They borrow money, but it's not financing a productive asset. It's not financing anything. It's being consumed, being pissed down the welfare drain. Whether it's welfare abroad or welfare domestically. And it doesn't, it's non-productive. But obviously the debt lingers and the interest accrues, and now at a much faster rate now than it had in a long time. The ultimate victims of this are the lenders. Now, the problem with this is that I know a lot of people that would become very insistent and very irate. Yeah, don't lend to those bastards, starve them for credit. And then I'm like, okay, well, how do you hold your, money? Oh, well, I have my money in the bank. Or I have a CD or a money market fund or whatever. I'm not lending to the government. Now, the problem is the dollar is just a thin slice of this debt. So whether you buy treasury bonds, then you're a lender. If you have dollars in the bank, you're still a lender. Most people don't realize it. And
Right.
you're a lender to the bank, and then the bank is a lender to the treasury. So what we call money today is all basically the government's debt. And then as it's been transmogrified through the banking system, so it's banking system debt, which the banking system uses to finance the government's debt. And all roads come back to Rome. It's all government debt. But at the heart of it, it's a counterfeiting operation. And so if you're the saver who's working hard and setting aside 10% of your wages, which that was the classic advice when I started my career anyways, set aside 10%, earn some interest on it, right? Well, you're completely disenfranchised. And the whole system in which you're invited to participate is based on a very fundamental, very central fraud. So in my argument, I have many arguments for gold, but the core of it, I think, is just the honesty of it, or dishonesty of the current system, and the honesty of a piece of metal. It is what it is. There's no argument about it. There's no gold monetary policy that lets debase it at a certain rate. You have an ounce of gold, you have an ounce of gold. And that honesty allows fair dealings between people. If I say, lend me something and I'll pay you back, and the thing I pay you back in, we've just changed, let's say we're both, merchants in the textiles business or the garment business. And I say, hey, I just need a bolt of cloth. Okay. Just a simple black cloth or whatever, right? So you give me this bolt, I'll pay you back tomorrow. And tomorrow I change the definition. I give you back a bolt of cloth, only it's like 2 meters short. Basically just cheated you. I've just defrauded you of something. And that's what the monetary system is designed to do. And they have all kinds of fancy rationalizations, for it, but ultimately it's cheating. And gold doesn't enable that cheating, which is why, before World War I, governments didn't like gold anymore, and they liked the idea of paper because gold didn't really allow the cheating. And the 20th century was, the rise of this sort of cheating on massive scale.
Right. And what's the vehicle to be able to bring it back to the mainstream?
So there's a fascinating situation that, and I use the term monetary science, that, people can see the observations, but they don't necessarily form all the inferences. And so I like an analogy to physics that, there's two, but we'll use Copernicus, that everybody saw. By that time, they had telescopes, they had other things like that. And everyone could see, even with the naked eye, there's certain planets you can see that, go across the sky at certain times of the year. They were trying to explain that. And then when you look at the planets, there's this retrograde motion. They go forward for a bit and then back and then forward and then back. And so the given explanation at that time, coming out of essentially the medieval period, was, religious in nature, and that all the planets are going around the Earth, and the sun is going around the Earth in this view. And it turns out, obviously, when you look at it objectively, that all the planets, including the Earth, are going around the sun, and that's why they appear to have this retrograde motion. It's because the Earth is passing them, or they're passing the Earth. The closer you're out of the sun, the faster you're going. The farther out, they move much slower.
Right.
So you look at the world today. There's massive amounts of gold. According to the World Gold Council, and I think they underrate it. According to the World Gold Council, there's like 200,000 tons of gold, which amounts to, at today's prices, I don't know, $14, $15 trillion worth. And that's most of the gold ever mined in human history. Gold is too expensive. Nobody throws it out. And if it ever is discarded in electronics or whatever, it's all recycled. Even people that are buried with gold teeth, at some point, the grave robbers come and recover that. If a ship sinks with gold on it, the divers eventually find it, most of them. So most of the gold mined over 5,000 years of human history is still held in human hands. That's saying something extraordinary, that the gold is still valued, and we continue to mine it even now, which means, there's no such thing as a glut in gold. It's sort of independent of its quantity. It has kind of a constant value. But it doesn't circulate. No matter how much gold is produced, there's a black hole in the market that will never fill. It just all gets gobbled up and bought and goes into private hoards, never to really see the light of day again. And people need some sort of incentive, to bring it out. So there's a famous quote by Keynes, who's kind of the arch enemy of honest money and the godfather of our modern system. And Keynes is talking about there's no surer way of overthrowing the capitalist order, which means civilization, really. And he was a socialist. He wanted to do this. This is how you do it, man. There's a better way than this. To debauch the money, blah, 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 blah. And most people assume he's talking about inflation. But when you get to the end, you realize it's not, because he said it leverages all the hidden forces of economics, which today we call incentives. And it does so in a way, in favor of destruction. And it does so in a way that not one in a million can recognize what's happening. And that's where I think he's not talking about inflation. I'm just old enough. I was a kid in the late 1970s. Every day, 5 days a week, the nightly news, they talked about inflation and what they call misery index, which is inflation plus unemployment. Today, everyone's talking about inflation. Keynes, if you didn't think that Keynes was aware that people would be talking about inflation, Keynes was not a moron. So I think what he meant was drive interest rates to zero, asset prices go up, inverse of interest rates, essentially. So asset prices go to infinity in a zero interest rate world, which is certainly what we saw prior to the Fed's recent, rate hikes. So I kept thinking about that quote from Keynes, leveraging incentives. And I thought, okay, what if you could offer an incentive to bring gold back to market? So all this gold exists. It's in private hand and nobody brings it to market. What if you could offer an incentive for them to bring it to market? What's the incentive? Well, if they can get paid interest on it, everybody wants to make a return. Today, gold is not a yielding asset, it's a costing asset. There's a cost to carry. And, if you store a few coins at home, there's no cost other than the implied cost of risk of loss, I suppose. You can't insure it at home. But, if you bring it into a professional depository, you're paying 50 or 75 basis points a year in storage. So it's a costing asset, which obviously makes it unattractive, but it never comes to market. It just sits there. And every once in a while, title changes hands after, usually decades. People hold gold the back corner of their portfolio. They don't really talk about it. They don't really, they bequeath it to their kids or they put it in a trust or something. And so, but if you pay interest on it, that's the game changer. That's the thing that brings it to market. And so we're all about, our trademark is a yield on gold paid in gold. That's what Monetary Metals does. And that's the mechanism to pull it out. And we use it to finance businesses. So our vision is to finance ultimately every productive business in the economy should be financed in gold. And there are certain advantages to that. And that everybody with gold can bring their gold to market and get a return on it. And if we achieve that objective, then, call it a gold standard. Maybe that word is too overloaded. There's too much baggage on it. I'm not hung up on the word, but, fundamentally you've given people an option that today they don't have. Yeah, they could buy gold, but it's kind of useless. And most people don't, but gold had a return on it. You give everybody that opportunity.
So tell me a little bit about how that works with the return and, when people invest with you, what that looks like.
So, gold is not recognized as money today. It's regulated as property, not as money. So we have, starts with a very conventional storage program, such as a lot of other companies offer. You can either send us metal and, deposit it into your account that way, or send us a wire of dollars and, we'll buy the gold and stick it in your account. And that's not particularly interesting. As I said, a lot of companies do that. But what we do then is we have two programs that are available to our, clients. One is leasing the gold and the other is lending it. And when we do gold loans, we parcel that out as a securities offering that we call a gold bond. So Monetary Metals issued the first gold bond in 87 years. So the last time there was any gold bonds in America, and for most of the world, was 1933 when FDR, killed it and made it illegal and then voided all the gold clauses and redenominated everything in paper. And there wasn't a gold bond, to the best of my research, until 2020 when we issued the first one. So we talk about leasing and we talk about lending with bonds. In a lease, This is for companies that have gold as inventory or work in progress. So there's about a dozen vertical industries, from refiners, mints, jewelers, recyclers, coatings companies, that all need a certain amount of gold, either as inventory, like if you're a jeweler, you have this store and you're spending a lot of money in rent, spending a lot of money on advertising, and the whole point is to get a customer to walk in your door. And you can measure like what's the cost per customer to walk in the door. If the customer doesn't see a product that they fall in love with, or that the right size, the customer walks out the door and you probably never see the customer again. So you have to have a wide array of different products to use, and for rings certainly, but I think also for chains and bracelets and necklaces, you need a bunch of different sizes. So you actually have to carry quite a lot of inventory just to make that sale when the customer walks in the door. So we will lease that inventory to them. That allows them not to have to tie up all their working capital in inventory, and not to have the risks of, once the price moves down, you may borrow $1 million, you buy your inventory, it is $1 million, the price of gold drops 10%. Now you have a $900,000 asset, you still have $1 million liability. You're insolvent. That's a very serious problem if you're financing with borrowed money. So then you have to hedge, which becomes complicated and has costs and moving parts, which means risk. And, we offer something much simpler than that. So what makes a lease is the owner of the gold retains the title to it. So it's not monetary metals asset, doesn't go on our balance sheet. If we were to go bankrupt, it's not available to our creditors, and it does not become the asset, does not go on the balance sheet, not available to the creditors of the lessee. If you're the investor, it's your gold. And then, if they go bankrupt, or you're getting your gold back. As for companies that have gold as inventory or work in progress, we can and do verify daily that the inventory is there where it's supposed to be. At any given time, we could show up on premises, scrape all the gold, put it on a scale, and show that, yes, it weighs greater than the lease amount. So that's what makes the lease a lease. The interest rates, not technically interest rates, the lease fee, but the interest that investors are paid when they lease their gold will vary between 2 and 5%, depending on the company and the jurisdiction. There's no such thing as no risk. Anybody who promises you a return without risk, run. That's bad. But it's the lowest risk thing, and there's tons that we do to mitigate risk here, insurance and diligence and monitoring and all kinds of things. It's the lowest risk thing that we can think of to do to generate a return and finance real productive businesses. The lending program is for businesses that have a gold income, not gold inventory. So think of a mining company. So they need to borrow X amount of money. In this case, we lend them gold. Now that gold is not sitting there in a vault. That's being sold to pay salaries and purchase or lease equipment, buy diesel fuel, pay contractors to put in roads and things like that. But that's a company that has a gold income. They literally pull gold out of the ground. So they can amortize the debt by generating gold income. Obviously, this is a on-balance sheet credit, unlike a lease. This is their asset. This is on their balance sheet. The gold is not there. You can't go on site and scrape it and put it on a scale. It's not there. It's been sold. But they have a gold income with which to amortize it. So it's an honest deal, unlike the way I described government borrowing to pay for welfare. But there's risk there. And so the interest rates on the bonds, when we do a gold bond, picture sort of mid to high single digits on the low end, up to about 19% on the high end. So it occupies a different place. One way to think of this is that there's a risk return spectrum. And in the dollar markets, there's a very fine granularity of all the different risks. I mean, you can hold cash or T-bills. Cash has no risk and no return. I guess T-bills at this point are paying a return that conventionally is considered without risk, at least in nominal terms. All the way through, bonds of AAA rated issuers, big public equities, real estate, private equity, and so on, and maybe even near-term options on triple levered ETFs, would be your opposite extreme. And there's a every millimeter along the spectrum, there's a product. But in gold, there's a barbell. I mean, on one hand, there's gold, the metal, which has no risk in gold terms and no return either. And then on the other hand is like the equities of the mining companies, which is extreme risk. And they promise high risk and high return, at least the potential for high return. And over the last 30 years, they've been pretty good at delivering on the risk side of that equation, not so much on the return side. But there's nothing in the middle. So monetary metals has created the lease, which has a little bit of risk and a little bit of return. It's not the gold metal, it's the lease. And then there's the bond, which has a bit more risk and obviously much higher return, but it's a lower risk than buying the equity of that same mining company. Because, any kind of problem, the creditors are paid first. The shareholders get nothing, the creditors are paid off. So, that's what we've done is we created those two assets. There'll be others as we go and as we scale. But conceptually, there ought to be a risk return spectrum in gold to match what there is in dollars ultimately.
Makes sense. What are some other examples of, so I got the jewelry one, but what are some other companies that need it as an inventory where you'd need to, or you'd be able to actually lease it to them?
Bullion dealers is another place where you just need plain inventory. And then there's several industries where it's really work in progress. So take a refiner. Every day the refiner is buying raw gold, let's say from the mines. And that raw gold, which is called doré in the industry, is anywhere between 75 and 95% pure. So it's a gold bar, but it has some impurities in it. It's not bullion grade. No investor would buy that, or jeweler for that matter. Because there's, potentially silver in there, copper, maybe even mercury, who knows what. So the refiners buy this, and then they process it by, melting it, producing, tiny little grains. The grains then go into the reactor, which dissolves it with acid. And then you can start adding different reagents to drop the gold, the silver, all those things are dropped out of solution. And then, they purify it, and then they can cast the pure gold into bars or coin blanks or whatever they might do. So every day they're buying a certain amount of raw gold. Every day they're selling a finished amount of product, but there's X amount of gold in the system, in the works, as it were, or a jewelry manufacturer versus a jewelry retailer. The jewelry manufacturer is buying raw gold, whether it's wire or bars or whatever. It takes a certain amount of time to, cut and squash and, polish and bend and weld, all this raw material into something that looks like jewelry. And let's say that takes a couple of weeks. Every day they buy a kilo. Every day they sell a kilo worth of finished product. But there's, 2 weeks in the middle, so you have 14 kilos of work in progress. So that's a great example where you'd have a lease.
Okay. Very interesting. Huh. That's neat. And then with the, and you said, so what about, say if you do one of the bonds for the example that you had with a mining company, and they're going to come in, they're going to mine for gold, and you're providing the bond, or you're buying the bond. And if something were to, do you get any kind of information on the company itself that you're kind of taking a risk on, or is that something you guys vet on your end, or what does that look like?
No, we're not taking any discretion over our client's gold. So we'll present. So bonds are for accredited investors only. I have to say that. It's not a general solicitation by any means. I can't talk about any specific bond that we, have in the hopper, public forum. But conceptually, we say, okay, this bond is coming. The clients that are interested, who are accredited, say, yeah, I'm interested. I'll take a look. So, I'm obviously based on a teaser. So, when I say, okay, they're interested, we give them a full slide presentation, and then there's a data room, and the data room would have everything. It's not just audited financials, which you'd expect, but it's all the geology. It's the competent person's report, which in North America would be 43-101. A lot of the rest of the world is JORC. These are sort of regulatory format. reports of what your resource is and, the economic feasibility of mining it. We present all that. We present the raw geology data that supports those reports, the mining plan, the financial model of how the capital is going to be used and what production starts, and how it ramps, and what the balance sheet is going to look like month by month as it goes through, how you're going to get repaid, what the legal structure is, what collateral you're getting to back it, what those assets, what we think of those assets and what they might be worth. All that stuff is all presented. So, the investor can make a informed decision, or ask more questions if they need to.
Yeah, no, that's great. That's good. That's fantastic. That's interesting. That so it's on a very specific. You're selling a bond basically on a very specific item where you can research the company. You can say, hey, they've got XX. They've had these other ones that have worked out well, and give the potential investor the full picture.
Right. Whatever the history is, if it's a public company, obviously what market they're listed on, what the ticker is, who the management people are, what their histories are. If they've successfully done this before, all that stuff.
Right. Okay. Yeah, that's different. That's neat. And then how do they normally do? And again, I know you can't talk about specific ones, but just from is it something that you typically see some kind of distribution on, or is it, and from a time frame standpoint, how long is that investment kind of tied up for typically?
So, there isn't, outside of monetary metals, when we say distribution, I assume you mean what brokers is this going to or whatever. There isn't, outside of monetary metals, a market for gold bonds, or for that matter, any awareness of what that term might even mean. So This goes to our clients exclusively. The terms or the tenors on the bonds are going to typically be short. So the leases are 1 year or less. The bonds will be 1 to 3 years. I think over time there'll be appetite for longer maturities, but right now I don't necessarily read it that people are hungry for a 10-year maturity on anything.
Yeah,
and it's just a function again of the world that we're in. As the interest rate goes haywire, everybody wants more and more liquid investments, because everyone just has to be prepared to change direction on a dime, which is kind of nuts. How do you have the most advanced civilization in the world and plan investment and long range projects if investors are trained to be that skittish in a way? But obviously the market is what it is. We have to acknowledge that. So the mining bonds will be probably, some of them will be 1 year, but probably 2 to 3 year tenors.
Okay. That's a different perspective. I've never heard that before. Although as we talked ahead of the show, I really haven't had too many guests on with respect to precious metals. So, are you primarily do gold then, from as far as precious metals go, or is there something else that you have your hand in as well?
Silver as well.
Do you? Okay.
Yeah, because those are the two monetary metals, and they've been money for thousands of years.
Yeah.
We get inquiries about platinum and other things like that. And platinum's a shiny, heavy, dense, doesn't tarnish precious metal, but it's an expensive industrial ingredient. It's not money. So, we've dabbled in platinum, but right now we just want to focus on gold and silver.
And tell me kind of your opinion of each. What are some of the differences between, for an investor? What are some of the differences between the two, and what do you see, in the future for those two?
So gold is the stable one. Gold is the thing that has the stability, and I argue not only is it more stable than the dollar, but actually it's the economic constant. People look at it and say gold is going up and down, and I say, if you're standing on the deck of a ship that's both A, sinking slowly, and B, tossing around in a big storm, and you're like, why is the lighthouse on those rocks over there going up and down and mostly up? Well, if you could just get off that vantage point and look objectively, you'd realize the lighthouse isn't going anywhere. You're going down and up and mostly down. So gold is that constant. Silver has volatility, and so it has the potential for greater upside in dollar terms, anyway, or in gold terms for that matter. But because of that volatility, also has a risk that I don't think you have with gold. So for somebody who's just thinking about getting started in precious metals, and by the way, I think everybody should. I mean, if nothing else, get 5 or 10 ounces and stick it in the stock drawer. Everybody should have at least something. And Americans understand gold the least. I mean, I travel all around the world, and most other places, because their paper currencies are much more obviously failing and have failed repeatedly. In Argentina, I mean, there's like a currency crisis. They lop 3 or 4 zeros off their currency, every 5 to 10 years, and it's been going back for a century. Germany had hyperinflation in the 1920s. Austria had it in the late 1950s. Southeast Asia, obviously, other places. Americans don't really get it. But anyway, everyone should have something. But if you're getting started in precious metals, it should be gold. Gold is the thing that's stable. It's a no-brainer. Silver, because of the volatility, is a little more complicated. Now you got to look, where is it in the gold-silver? Look at the gold-silver ratio, and varies within a range, and you want to understand where you are in that range. So if the gold-silver ratio is higher, that means silver is less valued to gold, or gold is more valued to silver. You think about buying silver here, and then on the other end, you want to think about not being in silver, because it has only one direction it can go at that point. But if we return to a metallic monetary system, then the gold-silver ratio would likely be a lot lower. So silver has a heck of a lot more upside than gold does. Anyways, it's complicated, right? Gold is a no-brainer.
Okay. And why does silver have so much more volatility, do you think?
It's always been the junior metal. So, if you look historically, the average person didn't really get their hands on gold historically. Today's a little bit unique in that anybody, even a blue-collar person working for wages, can buy gold. But, look at it. Gold is at $2,300 for an ounce. So you have to have $2,300 worth of savings to get one little coin that's like, the size of an SBA dollar. It's not very big. So gold is not only very dense in value, but it's also very dense in weight. An ounce of gold is a lot smaller than you think it is. Gold's about twice the density of silver. It's much, much, much heavier than lead or iron. If you had like an old format iPhone, the small one, and that was solid gold, it'd be a kilo roughly, which is, 200 pounds, much heavier than it has any right to be. If you had a similar amount of silver, you're talking, a couple of stacks, like poker chips on the table. That'd be, what are we at today in terms of ratio, 80 or something like that. So that same amount, it'd be 80 ounces of silver coin of that 1 ounce size would be twice the bulk of a 1 ounce gold coin. So wage earners, when they were saving, if you're putting $50 or $100 of savings per week into metal, you can get a couple ounces of silver for that. So you have something in your hand, and gold would be a little fleck. And more expensive. So silver is more efficient actually to do. And, gold was always the capital owner's asset. So gold trades as a capital asset. Silver, much more dependent on the wage earners. And the fortunes of the wage earners are more variable than the fortunes of the capital owning class. And especially historically, that was true. Silver is a smaller market. So a smaller market's going to be more volatile to some degree. And I think that silver also doesn't have that constancy of the market will absorb every new ounce on the same terms as the old one. So what I mean by that is, if there's an increase in the supply of silver coming from the mines, it'll have much more of an effect on the price. And then, the latest fad is somebody appears on TV and says something, boom, this spike in silver, plus 4.5% or something. You just never, almost never see anything in a move like that in gold. So, for historic reasons, for current reasons, silver is the junior metal. If the capital class decides that silver is a bargain, and you see hedge funds or somebody like that loading up on silver, I mean, they can move that thing all over the place. Whereas in the gold market, those guys are small. In the silver market, they're not necessarily small. It seems like every 30 years or so, somebody has to try, right? So in the late 1970s, the Hunt brothers, these billionaire oil guys out of Texas, tried to corner the silver market. Ultimately, they were bankrupted, and that was the end of that. Late 1990s, Warren Buffett, Berkshire Hathaway, thought they could corner the silver market. And they went bankrupted. They didn't go as deep in as the Hunt brothers did. And Warren Buffett kept a much more level head, to his credit. But they ended up leaving the silver market, and I don't think they ended up making any money on it. So maybe it would do for somebody to try to do that again.
Right.
Seems like, nobody's tried that in a while. Let's stick the fork in the electrical outlet. Because
right,
it'll work out good this time.
For sure. Is silver used a lot more, like in some electronics and different things as well? I always hear that the supply is more limited and that it's being used in these electric cars and this and that. Is there any truth to that?
I mean, both silver and gold are great conductors. Silver is actually a better conductor, I believe, than gold. Gold does not tarnish. Silver is pretty hard to tarnish, and you only get it. It's not like iron that'll just rust and completely corrode away. Silver gets a little bit of oxide on it, and I think that's a protective layer, but it's a very thin, sort of barrier. So they're both good for electrical contacts, for switches, and all kinds of things. Gold, I guess, if it must not fail, especially if it's in a salt or humid environment or something. But the difference is gold's at $2,300 an ounce, and silver is at $26 an ounce. So there's a strong disincentive not to put a lot of gold into your products. It's very expensive. And when the product is end of life, there's a powerful incentive to recycle that gold. And, every washing machine has a little silver in the contacts, and those things get pitched into landfill or whatever. Maybe today they're recycled, I don't know. There's so many things with silver that just at $26 an ounce, if there's a few grams of it, is it really worth all the effort of collecting all that trash, bringing it to the recycling center for $1 worth of silver? Probably not. So, it tends to go away. I don't think there's necessarily a deficit in silver, but, it tends to blow around in the winds a lot more. If all of a sudden solar panels get bigger subsidies, there's some silver in the solar panels, boom, all of a sudden there's this demand on silver, price can go up. Right, so silver has this industrial component to its price that gold doesn't really have. So you see this volatility that you don't have in gold.
Yeah, that's interesting. What about as far as what do you see as far as the economy? I mean, do you ever see us getting back to more of a gold standard, or is the inflation just going to keep on going until default? Or,
as I said, the more that the inflation happens and the closer we get to a default, I mean, all that debt matters. 34 trillion today. What was it at the end of Bush? I want to say it was 8 trillion. You know how time flies.
right.
Everybody has to be eyeing that a little bit nervously. It does actually matter. It's not just what's the interest cost to service it, but the actual debt itself matters. And you divide that by how many productive people are working in the private economy that supports it. Obviously, government employees don't support the debt. They are net payees, not payors in the system. Everybody's eyeing that nervously, as they debase the currency at a faster rate. Everybody's got to be looking at gold and silver, and that's why the price is $2,300. It's not $1,000 anymore, as it was a few years ago. As far as a return into a monetary system, I mean, in a certain sense, ain't nobody want that. All the mainstream people, including most of the sound money people, all they want is a Fed to manage, essentially plan the dollar a little bit better. What monetary metals is doing is trying to come at this from a different angle. It's not about teaching people the economics of it. It's about offering, people an alternative, and one that's, I think, a better alternative for your savings. Why would you want savings in something that, yeah, it can go up, but, mostly goes down? Wouldn't you rather have savings that can't be debased by governments who are deliberately debasing it? It's not like this is some internet conspiracy. I mean, right on the Federal Reserve's website, their goal, they call it price stability, but maintaining the purchasing power of the dollar. But right on their website, they say that means 2% inflation, chronic inflation forever. And so why would any saver want this? So we're offering an alternative that I think is a superior one. And, if we can scale it, we're still an early stage company, by any objective measure. But if we can scale it, then we're going to impact it, because that's what so many, former startups, Google, Amazon, eBay, Uber, at one time Coca-Cola, McDonald's, these are basically startups. And every entrepreneur that starts a company has a vision that if he's successful, figures out how to scale it, becomes really big, it changes the world in some, in some obvious way. I mean, think about, Apple wasn't a startup when they released the iPhone, but think about how different the world is today that we have smartphones versus, it was only 2007? That product was introduced, 2008, somewhere around there.
Yeah.
The mobile phone itself really only goes back. I mean, they had car phones in the 1980s, and J.R. Ewing in Dallas, had one, but it was so heavy and required power, giant antenna, it had to be in a car. In the 1990s, it was something that you could hold in your hand. It was like a brick, but you could hold it in your hand, pocket, flip it to your belt, But before that, I remember going on a job interview. Not only did you have to have a map in the car, you had to have some spare change. And if you were late and you couldn't find the address, you'd have to find a pay phone. Does anybody remember those?
Right.
So this is what startup entrepreneurs do, is we say, okay, I see a way that the world could be different from the way it is today. Am I right? Well, every entrepreneur thinks they're right. A lot of entrepreneurs have been very right. So far, knock on wood, we've been right, and we've, found a customer, and we're scaling, and it's working. If we get all the way, then we're going to change the monetary system the way Google and other companies changed, the internet, and the way the internet itself changed computers, and the way computers changed how business is done. Each wave building on the previous and doing the next thing and the next thing and the next thing. That's what we're aiming to do.
Yeah, that's fantastic. Let me ask you, Keith, how can people find out more about you, find out more about monetary metals, and if they'd like to invest, how can they reach you?
The company website is monetary-metals.com. On Twitter, I'm fairly active, and I'm at Real Keith Weiner. That's Keith. Oh, it's right on. I don't know if the video is going to show my name under the video of myself, but KHWN. We at Real Keith Weiner on Twitter.
Okay, perfect. And I've got just a couple more questions for you, if you have just another minute or two that I ask every guest.
Okay, sure.
Good. All right. How about any advice you would give somebody who's maybe just starting out in their investment journey?
Probably the single biggest thing is get educated. And by that, you got to read the conventional stuff. You definitely got to understand, the message of the Susie Ormans and the Dave Ramseys. And, it's about saving. Don't be thinking about, I got $100 burning a hole in my pocket. What consumer good can I buy? But think about, how can I start actually, accumulating wealth and getting it working for me? That's number one. But then get educated about how the monetary system is actually working. And, is it on a sustainable course? Is it on, a course that's ultimately going to fail? And of course, I recommend my own writings on the Monetary Metals site. And if you click on economics and then blog, I think, I have a few thousand articles that go back, 12 years or so. 14 years, right? It's 2020. I started writing about 2010. A wealth of material, but there's a lot of other stuff on economics. There's a lot of other stuff on the economy and the monetary system, and just get educated. And of course, I recommend read my stuff, but read everyone else's stuff too. And we'll see what the differences are of what I'm saying versus what anyone else is saying. And, of course, you have to make up your own mind, but get educated. There's a lot going on in the system. A lot of it is not what it seems. The world is kind of a mess, frankly. It doesn't need to be that way, but it is. And the better you understand it, the less likely that you're going to be, they call it a mug's game or retail rubes. The less likely you're going to be, one of those. Other than that, I can't think of what else to, say to people, buy gold. Sure, of course, but.
That's good. Now, I appreciate that. And then one other one, just any books you've read recently that have been impactful. Doesn't necessarily have to be related to precious metals, but it certainly can be.
Most of my reading actually nowadays isn't even really economic. I mean, I read the current stuff, of course, but in terms of books, mostly business stuff, and not necessarily recent, but a couple of business books that really stand out in my mind. One is The Innovator's Dilemma by Clayton Christensen. Another one is called Co-opetition. I don't remember who wrote that. That Barry Nailbuff, I want to say. Those books stand out, I think, as kind of really seminal books that kind of change how you think about business a little bit. And even if you're not planning on starting a business, if you invest in stocks, both of those books give you kind of a different way of looking at the companies you're investing in and asking, for instance, if you read The Innovator's Dilemma, it might give you a different answer to the question, is Tesla a disruptive innovator or is it something else? If you think it's disruptive, then there's no price for the stocks that's high enough, apparently. If you don't think it's disruptive, then, you might have a different investment thesis about Tesla. And that book will give you, this is not about me saying do or don't buy this stock. I'm not a stock analyst anyway. It's about how do you get educated? How do you think about these things? And that book presents a very interesting idea.
Yeah, I have not had either one of those recommended yet on the Wealth Flow, so I appreciate it. This has been really good. I've enjoyed our conversation, Keith. Really appreciate you being on the show.
Thanks for having me.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.